This is Sean Dillon, Technical Analyst for Pinnacle Advisory Group. So what is technical analysis analysis? It is the study of price and charts in order to gauge where price will be moving in the future. There are many different aspects inside of technical analysis. However, we're just going to look at a few of those today and hopefully get a sense of where the market is currently. That said, we're going to start with the most basic concept inside of technical analysis, and that is trend analysis. Even though it is the most basic, trend analysis is very important, so much so that one of the most famous technical sayings, "The trend is your friend," comes from this area. And what that means is that investors want to trade or invest on the side of the trend to have a much better chance at success. So we're going to look at the trend of the S&P 500, and this goes back to the beginning of 2011. And the market went higher for a few months into April, but at that point we saw a lot of volume on the sell side come into the market. That was further confirmed in July when we saw a bunch more volume come in, a lot more selling at a lower high than the April peak. And at that point we experienced what is known as a waterfall decline. A waterfall decline is a very sharp drop in price in a very short amount of time. In this case, the S&P 500 was down about 17% in just over 2 weeks or so. So that gives you a sense of the type of losses and the panic that was gripping the market at the time. It fell through July, had sort of a dead cat bounce, which is the market bouncing with no real buying coming in. And then there was further selling into the September bottom, down around 1100 on the S&P. And from that, we draw our first trend line. This is the bearish trend line that was created on the supply and demand forces, the supply forces in this case, and it signaled that the market was indeed bearish. But going into September, around that 1100, we finally saw some demand come into the market. This took place with a lot of short covering. Short covering is the investors who were short or hoping that the stock market is going down are covering their bets now that they've made some money, and that naturally propels the market higher. So we were a little skeptical at the time as to whether this was a change or not. However, we further confirmed in November when we came back down. The blue line, as you see, is falling back down, touching the red line. At that point, more buying came in, and we initiated our new bullish trend. And that's where we stand right now. The trend is bullish. It is a friend of the bulls, and we have powered higher through the early part of 2012 here. Now, not only is the trend very bullish right now, but we're seeing lots of participation in this market. And how we measure that is through breadth analysis. Breadth analysis measures how many stocks are advancing versus decline. In this case, we're using an advanced decline line, which is very simply a line that moves up when more stocks gain than lose, and it falls when there's more declining stocks versus advancing stocks. I want to point your attention to the bottom of 2009, both the S&P 500, which is the bottom chart, and the advanced decline line, which is the top chart. Both made their bottom and screamed higher through 2011. At that point, we had that waterfall decline, the advanced decline line, and the S&P 500 fell back. We bounced at 1100 on the S&P. The advanced decline line also bounced higher. However, there's one noticeable difference, and that's that the advanced decline line has made a new high. It bounced over its 2011 peak. Now, subsequently, this chart was made a few weeks ago. The S&P 500 has broken its 2011 peak as well, confirming this indicator. So it's a very good sign that there's a healthy bull market here, and it's not just being driven by one or two names. I do want to point out one thing that could be distorting this indicator, and in fact distorting a lot of indicators, and that's that there's lots of government intervention right now. Rick and Carl and Ken have already spoken on the massive stimulus that's hitting the market, lots of money moving around, and that could be creating a false impression of strength in what we're calling a risk-on, risk-off environment, where all stocks move up together and all stocks fall together. So not only do we want to see the S&P 500 break 2011 highs, which we have seen, We also want the small cap indexes and other indexes like that to confirm as well in order to be a lot more comfortable with the strength here. This next slide, I'm going to talk about intermarket analysis. Intermarket analysis is the study of different markets together and how they're performing against each other in order to determine the strength of the market as well. In this case, we're going to look at some domestic cyclical stocks. Cyclical stocks are stocks that perform or outperform when the economy is doing better. And let's take a look at that versus the S&P 500 again. The S&P 500 is in the blue line. It had an amazing run, even though it doesn't look that impressive on this chart. 25% or so in just a few months. An annualized 60% return, just a fantastic return. However, those domestic cyclical stocks that I was talking about, such as home builders, semiconductors, energy services, and small caps, have all outperformed. And not only outperformed, but some of these have doubled and tripled the S&P 500 return, which is very good to see. These are outperforming because the economy is getting better. The cycle is turning back up, and as long as this continues, we have a lot of confidence that that'll continue throughout the rest of the year. Now, in the rest of the year, we're also seeing a lot of good signs on the seasonal analysis side. Seasonal analysis is just finding or combing through the data and finding repeatable patterns. And in this case, we're looking at the presidential cycle, and more specifically the election year. Because we are in an election year this year, we wanted to see how the market typically performs. We're looking at the S&P 500 going back to 1928. You can see just fantastic returns, only 3 down years out of 21. And then at the very far right of the chart, there's a green bar that shows the averages of those years. That average is roughly 12% or so. When comparing it to the other 4 years, or all 4 years combined of the presidential cycle, we see an average return of about 9%. So we're looking at 3% gains per annum, better than the average inside of election years. Just fantastic returns, and that points to further strength for this year. Not only that, but we're seeing a lot of other good seasonal signs, such as as January goes, so goes the rest of the year. January had an amazing month, up 7% or so in the S&P 500, and typically that says about 90% of the time we're going to have further gains from February to December, and we certainly saw that in February with another great month from the S&P. Now, those are a lot of the bullish signs that we're seeing inside of the technical arena. But there are also some bearish things that we're seeing as well, and I'm going to start pointing those out here. With the first being, we're seeing a bearish divergence inside of momentum. Momentum is the study of price changes in order to gauge the enthusiasm in the market. In this case, we're using a MACD indicator, or the moving average convergence divergence indicator, which is the bottom line in red, and we're going to measure that against the S&P 500. Both of these indicators bottomed in 2009, and again, continued higher through 2011 when we hit that peak in April. At which point, we started seeing this divergence. The S&P 500 fell, but has since bounced back above 2011 highs, creating newer highs in that index. But the MACD indicator, the momentum inside of the market, is still falling. This is a very clear warning sign and something to monitor. It's not an exact sell signal, but it does present the potential for bearish outcomes. The second thing that we're watching that is very concerning is within sentiment. Sentiment is the study of investor behavior in order to find out if they're greedy or fearful, or instead of greedy, we sometimes say complacent, as this chart says. And in this particular indicator, or this instance, we're using the CBOE volatility index, which is also known as the VIX index. When the VIX index is very high, it means that people are very fearful, and contrarily, that's when you want to be investing. Warren Buffett had a famous saying, "You want to buy when there's blood in the streets," and that's exactly what we want to do when people are really fearful about future economic situations. That's when you want to be buying, because stocks are probably at a good value. Conversely, when people are too complacent, they're not looking for anything negative. It's all positive, positive, positive. That's when negative outcomes can present themselves. And in this particular case, we're at about a 17 or so on the VIX index, which is a low that we have seen over the last 4 years, which indicates that investors right now are very complacent, and we have to be on the watch that any negative news that comes right now, there could be a lot of fuel to the fire, and that produces big gains, big negatives. The last slide, we're going to go back through some intermarket analysis. In this case, we're going to go over relative strength charts inside of the commodities in China. The top chart is a relative strength chart of commodities versus the S&P 500. When the green line is rising, commodities are outperforming. The green line is falling. The S&P 500 is outperforming. Right now, we're seeing the S&P 500 really outperforming commodities since the middle of last year. That's a very clear warning sign. Again, commodities are usually very highly tied to the economic cycle. A lot of producers, when they're making goods, demand these commodities. Typically, we see commodities leading. Right now, we're not seeing that. It's a clear warning sign again, and we'd love to see a pickup inside of commodities, and more specifically, industrial metals like copper, tin, and nickel. And then the bottom chart is the relative strength chart of China versus the S&P 500. Again, the green line is falling, which indicates that the S&P 500 is outperforming China. Again, another bearish sign. We like to see China and the highly beta, highly cyclical emerging economies also performing very well in order to have more confidence in the strength of the bull market. This is a clear warning sign that China is having massive problems and is one of the biggest concerns inside of our investment team, that China may be experiencing a hard landing. We've yet to see it yet, but they've had lots of problems with inflation and their property bubble, and this chart points to that and is showing you that it's not the place to be investing at this time. So with that, in conclusion, we would say right now that technical analysis, our analysis, is pointing neutral. Very much the same as our tail of the two tails theme here. On the good tail side, we have trend analysis is clearly bullish. Seasonal patterns are very strong, and our market breadth, we're not being led by a few stocks. Even though they may be in the news a lot of stocks are rising. Right now, we're seeing some divergent signs inside of Intermarket analysis, where we have our highly domestic cyclical stocks, or our domestic high cyclical stocks outperforming the S&P 500, but we're seeing our high growth commodities and our cyclical emerging stocks underperforming. And then on the bearish side, we're seeing a momentum setup right now that is pointing bearish. And then our sentiment is overly complacent right now. Not a lot of people looking for what could be wrong here. A lot of bulls in the market right now, especially on the analyst and advisor side. So definitely clear warnings. And in order to get a little bit more of a bullish feeling in this market, what we would like to see again is the S&P 500 breaking out to new highs like it just has. But also we'd like to see the small cap index break out to new highs. And we'd like to see some enthusiasm come back into this market, a little momentum pick up, and then a reverse of the equity flows that Rick showed you, which is a lot of equity outflows over the last year or so. We'd like to see that reverse itself and see people want to buy stocks at this time.